By far, the most important news of the week centered around tariffs. Today, Friday morning, President Trump announced a slew of tariffs with countries that have not reached an agreement with the United States. The S&P and NASDAQ fell a bit over 2%. The market finally had a bit of a correction, and all this because of tariff news. This is a very big week for earnings. There was some interesting M&A news this week. United Health. This stock has not found a bottom. Pretty bad picture. The massive AI bets that Zuckerberg has made are paying off. The underlying fundamentals of the United States economy are quite strong, but this week makes clear that the story is far from over. And the big question is this. Hi, this is Steve Eisman, and welcome to another edition of the Weekly Wrap. There were plenty of earnings this week, and many important companies reported, but by far the most important news of the week centered around tariffs. So I'm going to spend quite a bit of time on that first. The week began with President Trump announcing a deal with the European Union. The deal will levy a 15% tariff on most of the EU's exports to the US, while reducing levies on many American products to zero. And if I had to characterize the results of these negotiations, I'd say that Europe mostly caved. From a purely analytical perspective, my guess is that the European country most negatively impacted is Germany, because its economy is the most export-driven. The next important deal is with China, and that deadline is August 12th. Here's a summary of where we are at negotiations with various countries. I'm putting a table on the screen that first shows those countries like the EU, South Korea, that have reached a deal with the United States. And the second part of the table shows a few countries, a select group, that have not yet reached a deal and the threatened level of tariffs that President Trump is lodging against them. I want to focus on India just for a minute because of the rhetoric involved. On Wednesday, President Trump said he would impose a tariff of 25% on India starting August 1, which is today, and suggested that he would add an additional penalty over India's energy purchases from Russia. In an angry post, a very angry post on Truth Social, President Trump stated that India's tariffs were among the highest in the world, and they have the most strenuous and obnoxious non-monetary trade barriers of any country, end quote. And then he continued and said, quote, also, they have bought a vast majority of their military equipment from Russia and are Russia's largest buyers of energy, along with China, at a time when everyone wants Russia to stop the killing in the Ukraine, unquote. It will be interesting to see how India responds. Now, the deadline for trade negotiations was today, August 1. And today, Friday morning, President Trump announced a slew of tariffs with countries that have not reached an agreement with the United States. These countries include Cambodia at 19%, Taiwan at 20%, and Switzerland at 39%. I guess the president really does not like Switzerland, though I'm not sure why. Perhaps he is just trying to put pressure on them to reach a deal and soon. In addition, all goods that are considered to have been, quote, transshipped, unquote, to other countries and then shipped to the United States so as to avoid applicable duties will also be subjected to an additional 40% tariffs. All of these tariffs will go into effect next week on August 7th. I focused quite a lot on this week's tariff news because the underlying fundamentals of the United States economy are quite strong, and in my view, the only thing that can derail it is a trade war. So far, many of the negotiations with key countries have gone better than expected, but this week makes clear that the story is far from over. And the big question is this. Without a doubt, the global economy will be functioning with a higher level of tariffs than before. What will be the implications of that? I'm sure the answer to that question will be multifaceted, but we won't know that answer for quite a while, perhaps even years. Moving on. On Wednesday, the Federal Reserve announced that it was not cutting rates, but two Fed governors dissented and voted for a rate cut. But interestingly, on Friday, today, July U.S. non-farm payrolls came in at a lowly 73,000 versus the 104,000 estimate. Also, June's non-farm payroll of 147,000 was revised down to a mere 14,000. This allowed President Trump to renew his call for the Fed to cut rates immediately. Meanwhile, the U.S. 10-year Treasury yield fell to 4.23%. And now for the stats. For the week ending August 1st, the S&P and NASDAQ fell a bit over 2%. The market finally had a bit of a correction, and all this because of tariff news. For the year, the S&P is now up over 6% by a bit, and NASDAQ is up a bit over 7%. Moving on. There was some interesting M&A news this week. First, Union Pacific agreed to acquire Norfolk Southern, 2 railroads. Normally, an M&A deal would not be a big deal, but this one actually is. Why? Because it increases industry concentration in railroads by quite a lot. There is no way the Biden administration would have allowed this deal to go through. The companies would not even have attempted it. If it goes through, and I'm betting that Union Pacific's advisors have gotten a wink and a nod from the Trump administration, it would usher in a massive M&A wave. And there was also another fairly large M&A deal announced this week. Palo Alto Networks, a leading cybersecurity tech company, announced it was buying CyberArk, another cybersecurity company, for $25 billion. If you're thinking about stocks that could benefit from an M&A wave, I'd look at M&A advisors. Goldman on the large cap side, and on the boutique side, companies like Evercore and PJT Partners. Full disclosure, I own PJT Partners. In more economic news, U.S. economic activity rebounded in the second quarter to a quite strong 3%. And before we get to earnings, there was some important pharma news. On Thursday, President Trump sent a letter to the CEOs of big pharma companies. A few months ago, President Trump threatened big pharma if they did not cut drug prices. He was unsatisfied with pharma's response, and hence this new letter on Thursday. He called on drug makers to provide most favored nation prices to every patient enrolled in U.S. government health programs, and to guarantee such pricing for new drugs. He also is requiring drug makers to stipulate they would not offer other countries better prices than what they offer in the United States. He gave the companies until September 29th to respond. Needless to say, pharma stocks were under a lot of pressure on Thursday. Now, this is a very big week for earnings, with 161 companies reporting. I'll cover only the ones I find interesting and or important. First up, Novo Nordisk, the pharma company. Now, normally I don't comment that much on foreign companies, but Novo Nordisk is an important company that has pioneered weight loss drugs with its blockbuster Wegovy. However, of late, it has been losing market share to Eli Lilly's Mounjaro and to some other cheap alternatives. And on Tuesday, Novo cut its sales and profit forecasts, citing slumping sales of its weight loss drug. This is the second time this year alone that it has cut forecast. It also named a company insider as its new CEO, and the stock was down over 20%. United Health, the health insurance company. This stock has not found a bottom. It reached a peak of over 600 in 2024 and has been cut by more than 60%. UNH suffers from a series of problems. Healthcare costs are climbing, and UNH's loss ratio is climbing with it, and it cannot seem to catch up with increased pricing. Also, it is reportedly being investigated by the federal government about billing practices and the accuracy of claims submitted by it to Medicare and Medicaid. A pretty bad picture. The company reported this week and cut its guidance for 2024 from $20.40 to $16, and that is quite a cut. Now, I know there are several people who like to invest in turnaround stories, but this feels a little too early to me. And on the day it reported, UNH was down over 7%. The stock is now back to where it was in the summer of, get this, 2020. Next up, PayPal. Like I've said before, the payment space is a brutal one. In my view, only Visa and MasterCard have truly great business models. Everywhere else, payment companies are going after each other's businesses. PayPal was once the darling of the space, but that has not been true for several years. To give you an idea of how much this company has fallen from investor grace, the stock reached a peak of almost $300 in 2021. It is now, get this, 67. On Tuesday, the company's EPS of $1.40 versus $1.19 last year, and which beat the estimate of $1.29. So that sounds okay. But it also reported a slowing in payment volume growth to 5% in the June quarter from 6% in the March quarter. And in the payment space, that is death, because everyone immediately assumes, rightly or wrongly, that that means you are losing market share. And on Tuesday, the stock was down almost 9%. Moving on, Boeing. What has happened to Boeing over the last few years is certainly worthy of an entire business school class, a book too. Bad management, plane crashes, faulty manufacturing processes, loss of market share. Quite a list. The stock reached a peak of 270 in March of 2021 and has got as low as 120 in 2022. It's been all over the place, but it has climbed back to around $220 as of today. The market has been very patient with this company. Why? Several reasons. This is a strategically important company for the US, and the US government is not going to let Boeing go down. Also, the manufacturing of planes is basically a duopoly. Once Boeing gets its act together, it can't help but make money. And finally, the underlying fundamentals of the industry are actually quite strong. Plane travel keeps increasing, and airlines keep ordering more planes. It's why the results 2 weeks ago for GE Aviation, which I discussed 2 weeks ago, which makes aircraft engines, were so good. As for Boeing's results, Boeing almost halted its cash burn in the second quarter. It reported a smaller than expected loss for the quarter as revenue beat estimates, and sales reached $22.75 billion, which was actually 35% growth year over year. Starbucks. Lesson: turnaround stories are difficult. They take time, even when there is a good new CEO. Brian Niccol turned around Chipotle. He's now trying to turn around Starbucks. His tone on the conference call was very positive, claiming that the turnaround was, quote, ahead of schedule. But the numbers are still weak. Same-store sales growth was down 2% in the quarter, which was worse than expected. Earnings per share was 50 cents, well below the 65 cents expected. Frankly, I did not see anything in the numbers to suggest that Starbucks fundamentals are getting better, but Niccol has a lot of credibility from his time at Chipotle. The company reported Tuesday night, and the stock was flat on Wednesday. Visa. Full disclosure, I have owned this stock for a long time. The payment space is hard, and yes, stable coins represent a potential threat. But since Visa and MasterCard went public in the early 2000s, every few years someone comes along to challenge them. And then eventually they are forced to team up with Visa and or MasterCard because their networks are just too powerful and too big. Not that stablecoins won't have a role in the payment systems, but supplanting Visa and MasterCard is a brutal enterprise. One additional point. Yes, Visa and MasterCard have great businesses, but they are not immune to the economic cycle. If the consumer stops spending, they are hurt. No way to avoid that. Anyway, Visa reported this week, and earnings per share and revenue were fine. More importantly, it saw 8% payment volume growth versus the same growth rate in the March quarter. So the consumer looks pretty resilient. As for earnings, Visa reported $298 versus $242 last year, and versus the estimate of $285. Microsoft. The June quarter is Microsoft's fiscal fourth quarter, and it was a powerful quarter. For the quarter, Microsoft reported earnings of $3.65 on revenue of $76.4 billion. Earnings per share was up 17%, and revenue was up year over year 18%. Both beat consensus. The standout in the quarter was Microsoft's cloud business called Azure, with revenue growth of 39%. Quite fantastic. As a result of these excellent results, the stock rallied 4.5% after hours and reached the $4 trillion market cap level during Thursday morning, only to fall back below $4 trillion by the end of the day. The strength of the company's quarter, especially on the revenue side, points to the power of AI on the entire tech sector. $4 trillion companies don't grow revenue by 18% year over year. Normally, that would be a mind-blowing statement, but for the fact that in the March quarter, NVIDIA grew total revenue by 69%. Still, the Microsoft numbers were superb. Meta, also a great quarter. This quarter showed that Meta's ability to harness AI to drive better monetization and engagement supports the idea that Meta's advertising revenues will grow faster and for longer than many would have expected. Total revenue grew a very strong 22%. EPS grew 24%. Again, these are numbers you might expect from a much smaller company. And revenue growth actually accelerated, showing that the massive AI bets that Zuckerberg has made are paying off. The stock rallied 11% on Thursday. Comcast. The market's positive reaction to Comcast's results is not, I repeat, not an example of fundamentals, but of expectations. Now, last week, Charter missed numbers and the stock got obliterated. Comcast results this week were just plain bad, but they beat already beaten up expectations, so the stock rallied a bit. In cable world, investors care mostly about net additions to broadband. Comcast reported domestic broadband subscriber losses of 226,000 compared to a loss of only 126,000 a year ago, which is really bad. But the consensus was for a loss of 257,000. So the loss was better than expected, but it was still bad. That's why the stock rallied. But don't get carried away. The stock reached a peak of $57 in June 2021, and it's now $33 and is down 12% this year alone. Just to add to how poorly the market thinks about cable stocks, Comcast's free cash flow yield is 13%. Charter's is 25%. Now, free cash flow yield is where you take a company's annual free cash flow and divide it by the company's market cap. Valuations like that imply the market thinks these companies could go out of business. Now, I don't think cable stocks are, but no one seems to care. Moving on. S&P. Last week, Moody's reported. This week, S&P. The two rating agencies run a duopoly and therefore have pricing power. They tend to usually report good results, and S&P reported earnings per share of $4.43, up 10% versus last year and beating the consensus. It raised revenue and EPS guidance, and the stock rallied almost 5% on Thursday and is near an all-time high. Amazon. Another example of the perils of predicting how a stock will react from earnings. On the positive front, earnings per share was $1.68 versus $1.59 last year and was a beat against expectations. Net sales were $168 billion, up 13% versus last year, and also a beat. The all-important AWS division, which is the cloud division, reported sales of $30.9 billion, up 17% versus last year, but it missed expectations. And overall guidance was questionable. On the revenue front, guidance for the third quarter was fine, but operating income for the third quarter was guided to between $15.5 billion and $20.5 billion. The midpoint is $18 billion, but the consensus is looking for $19.4 billion. So the stock was down pretty sharply after hours Thursday night. Apple. The stock is down around 18% this year. The only Mag 7 stock that is worse is Tesla. There was a lot of skepticism about Apple going into the quarter because Apple faces many issues. It manufactures virtually all of its products in China and therefore is a prisoner to U.S.-China trade negotiations. It is behind in AI. It is losing phone share in China. But second quarter results were really quite good. iPhone sales blew past Wall Street expectations as some U.S. consumers rushed to buy iPhones before potential price increases from tariffs. iPhone sales were up 13% year over year, which was the highest increase in years. Total sales were up 10%, and that beat the estimate too. And earnings per share was $1.57 versus $1.40, whereas the estimate was only $1.43. But despite this strong beat, the stock was up around 2% after hours Thursday, which just shows that the skepticism persists. And on Friday, the stock gave up its gains and was down for the day because of the market's negative reaction to President Trump's tariff news, which I spoke about earlier. And now for the mailbag. Last week, I mentioned that I would be posting some financial literacy masterclasses and asked any of you who are interested to send in questions that you would like me to address in future literacy classes. I received a lot of questions, and we are going to post the first financial literacy masterclass soon after Labor Day. But given the number of questions, some of which I don't actually address in the financial literacy class, I've decided to do an extra podcast specifically dedicated to answering many of these questions that I do not address in the financial literacy lecture. That special question and answer podcast will drop the week before Labor Day. So I'm saving many of those questions for then, and please send in more. Today, I'm just going to address one mailbag. This is from Dominic Isaac, who writes, "Hi, Steve. Allow me to briefly introduce myself. I'm a 24-year-old student from Germany with a deep passion for investing. Over the past few years, I've immersed myself in books, investment memos, and anything I can get my hands on to learn more. One area I constantly grapple with is portfolio management. How should I think about position sizing? Is it better to establish a full position up front or leave room to add on weakness? Should I rebalance, and if so, when? And perhaps the toughest question of all, when is the right time to sell? I would love to hear your thoughts on this. Wishing you all the best. So my answer to that is there's really no right answer to this question. And I actually do it differently now. In my hedge fund days, where I traded much more than I do today, I legged into positions over time. But that was just because I was much more trading oriented. Now, I just invest for the long term. So once I've decided to buy something, I just take a full position. I find that legging into it just introduces so many variables that it just isn't worth agonizing over, especially if you have a long-term investment horizon. Now, when to sell? I actually do address this on the financial literacy class, but I'll give you a preview. If you're a long-term investor, I think you just keep your position as long as your thesis is intact. And I don't pay that much attention to valuation, again, as long as my thesis is intact. I let the market decide on valuation, and I just decide if my thesis is still good. That's what long-term investing is mostly about. So when do I sell? When I realize that the story has changed and my thesis is no longer valid. And I'll have a lot more to say about this in my financial literacy lecture. And that's the wrap. This coming Monday, my guest is someone who's been in venture capital for years. He brings a perspective about venture capital that I think you will not find anywhere else. Venture capital has had a huge growth phase, but according to my guest, starting in 2022, entered into a depression. I don't think you will read about this anywhere. My guest also believes that many funds will fail, and the areas of venture capital new investment have narrowed considerably, almost solely to AI, blockchain, and crypto. Hope you tune in. If you haven't already, please consider subscribing to our YouTube channel so that you can receive these weekly wraps along with our podcast and the financial literacy masterclasses, which we will be releasing soon. Subscribing is the best way to help the channel, and we greatly appreciate your support. And see you next time. This podcast is for informational purposes only and does not constitute investment advice. The host and guests may hold positions in stocks discussed. Opinions expressed are their own and not recommendations. Please do your own due diligence and consult a licensed financial advisor before making any investment decisions.